So in this new unit, we are starting a new module and a new look at the production process. We are going to go behind the supply curve, and in this unit, we're going to focus on individual firms, how they make decisions based on their costs of production, and how they maximize their profits, and how they determine how much of a quantity to supply us with in the market at different prices. So in the last unit, we went behind the demand curve to explain and understand consumer behavior. In this unit, we're going to go behind the supply curve to understand and explain producer behavior. So we begin in this first module by defining and looking at how we maximize something that is very important to business firms, and that is their profit. In a market economy, that is the motivating factor. That is the primary incentive for businesses to supply us with the goods and services that we want. They want to maximize their profits. And without profits, they are not going to supply us with those goods and services. So we have to understand, first of all, what profit is, how they understand it, and how to maximize it. And we're going to do that in the two modules that we'll be looking at now, Modules 52 and Modules 53. Module 52 is all about defining profit, and then Module 53 shows us how businesses maximize their profits. So let's get started with this. In this module, what we are going to learn are these things. First, I'll explain to you the difference between explicit and implicit costs and how important they are in making decisions. We'll describe the different types of a profit, including economic profit, accounting profit, and normal profit, and then we'll learn how to calculate profit. So the first thing we have to do is to think about how profit relates to revenue. Revenue is money that is taken in by a business firm. It is not the same as profit. Revenue is money coming in. And so we calculate revenue by multiplying the price of a good times the quantity of the good. So if we were selling glasses of lemonade for $1 a glass, and we sold 10 glasses, we'd multiply $1 times 10, and that would be $10, and that would be the revenue taken in by the firm for selling 10 glasses of lemonade. But it would not be their profit, because that's only money coming in. They also have to pay costs for production. They have to pay for land, labor, and capital. Those are inputs. Those are factors of production. Land is the natural resources that goes into making the lemonade, the ingredients of it. Labor would be the human effort and workers that are used to produce it. And capital would be the equipment and tools and machinery that's used to make these things over and over again. And so all goods and services are made from these inputs, the factors of production of land, labor, and capital. And so they have to be paid for. And when we say they have to be paid for, that means they have to be subtracted from revenue, and then any money that might be left over would be the profit of the firm. So firms are assumed to produce the level of output that maximizes profit. And profit, as we said, is equal to total revenue minus total cost. Now, accountants and economists both define total revenue as equal to the quantity of units sold multiplied by the price at which they were sold. In other words, total revenue equals price times quantity. But the more difficult component of profit is the precise definition of total cost. How do we calculate the total cost of producing something? Well, to do this, we have to understand the difference between explicit costs and implicit costs. All costs, whether they are explicit or implicit, are opportunity costs. Remember what an opportunity cost is. It's what we give up to get something that we want. So it's the next best alternative. So whatever is the next best alternative you would do with your resources instead of what you're currently doing with it is what you are giving up, the opportunity cost of that. But there are two things that make up opportunity cost. So an explicit cost is a cost that involves actually laying out money. When you actually take money out of your pocket and you pay for something, that is an explicit cost. So examples would include paying rent for office space, paying wages to your employees, paying interest on a loan or a debt that you owe, paying for raw materials, paying for depreciation on equipment that is getting older, paying for your utility bills like gas, water, and electric. These are referred to as accounting costs. And so when accountants determine the profit of a firm, they only include explicit costs, actual money that is being paid out. And that is what most of you are used to thinking of when you think of profit. So when you say a firm is profitable, you're thinking about explicit costs only, because that's how tax lawyers do it, that's how accountants do it, and when people talk about profit, they usually only are talking about explicit costs. But economists are different than accountants. Accountants only count explicit costs, but economists count both explicit and implicit costs because they say they are both given up in order to do something. So an implicit cost does not require an outlay of money, but it is measured by the value in dollar terms of the benefits that are foregone or given up. So in other words, you're not paying out money, but if you did something else with your resources, you might be able to bring in money with those resources, and because you're not, that is a benefit given up. And it is an opportunity cost of using those resources. So we call that an implicit cost. So examples of this would be if you go to college instead of getting a job. The salary you would have made at that job, you're not paying that out of your pocket to go to college, but you are giving it up because you could have had it. So that is given up. If you take your savings out of a savings account and you could have earned interest on it, the interest that you would have earned is now given up when you take that savings out of the account. A building or other capital that you could be renting instead of using it yourself is money that is given up. And so as a result of that, there is a problem with this. So these implicit costs are referred to as economic costs. Now, because most of you don't have personal experience with entrepreneurship, explicit and implicit dollars will be a little bit more difficult for you to understand at first. Explicit cost, tuition that you pay to college for 4 years. Implicit cost, wages that could have been earned over those 4 years. Now, businesses can face implicit costs for two reasons. A business's capital could have been put to use in some other way. Capital in a business is the value of its assets, equipment, buildings, tools, inventory, and financial assets. And they could have used all those for something else and earned money by using them for something else. And maybe they could have earned more money by doing that. So the implicit cost of that capital is the opportunity cost of the capital used by a business. The income the owner could have realized from that capital if it had been used in its next best alternative way. So here's an example. Betsy has borrowed money from the local bank and purchased a building so that she can open up a shop that sells women's clothing. Each month she writes a check to the bank on her debt. This is an explicit cost of her capital. Betsy's friend is a real estate agent who tells her that she could rent at $1,000 per month her building to James, who is seeking a shop from which to sell his antiques and curios. If Betsy forgoes this $1,000 of rental income, she's incurring an implicit cost of her capital. The second reason why businesses incur explicit costs is because the owner devotes time and energy to the business that could have been used elsewhere. Considering the cost of an activity, you should include the cost of using any of your own resources for that activity. The most personal of these resources is the value of your labor in the next best occupation. So for example, Betsy worked in the women's clothing section at Macy's and earned $45,000 a year. If she quits this job to start her small business, the salary she gives up is $45,000, which is her implicit cost of going into business for herself. Here you see another example of that. If you go to college, what is the real cost of going to college for a year? Well, most of you would think of the explicit cost only. You pay $17,000 for your tuition, $1,000 for your books and supplies, $1,500 for your computer, and you'd say, oh, it cost me $19,500 to go to college. But wait a minute, an economist would say, no, it actually costs you more than that to go to college for a year. Because if you didn't go to college, maybe you would have worked at a job earning $35,000 a year. And because you're going to college, that $35,000 is money you're giving up. That's not money you're taking out of your pocket to go to college, but it is something that you're giving up by going to college. And so if you add that $35,000 to the $19,500 you take out of your pocket to pay to go to college, it's really costing you $54,500 to go to college each year. An accountant would say it's costing you $19,500 to go to college. An economist would say it's costing you $54,500. That's what you're really giving up to go to college. Now, does that mean you shouldn't go? Not necessarily. But it does mean that when you're determining benefits versus costs and whether you should go to college or not, that you should consider the real cost of going to college for a year is $54,500, not $19,500. And if that's still worth it to you in the long run, then you should make that decision. So let's look at the difference between accounting profit, how accountants count profit, versus economic profit and how economists count profit. Companies report their accounting profit. So when companies report their profit to the Internal Revenue Service for tax purposes, or they publish their financial statements showing how much money they came in and how much money is going out and whether they made a profit or not for stockholders, or they determine whether or not they have a profit with their accountant, they are determining their accounting profit only. And that is not necessarily equal to their economic profit. The accounting profit of a business is the business's revenue minus explicit costs and depreciation only. It does not include implicit costs. It only includes explicit costs. So the economic profit of a business is its revenue minus the opportunity cost of its resources, both explicit and implicit. So it is usually less than the accounting profit. Economic profit, because it includes both explicit and implicit costs, would be determined by taking the total revenue of a firm and subtracting the explicit costs and also subtracting the implicit costs. What you're giving up, the other thing, the money that you could bring in by using your resources, land, labor, and capital for other income, rather than operating your business. So how would they do this? Okay, well, accountants versus economists. Here's another way of looking at it. Accountants look at only explicit costs. They're out of pocket. They're paid by firms for using the resources of others, and we've discussed some of these examples. So it's total revenue minus explicit costs only, and things like rent, wages, materials, electricity bills, and things like that. Economists, they look at both explicit and implicit costs, and implicit costs are the opportunity costs that firms pay, in quotes, for using their own resources. So wages you give up, rent that you could have had for the building that you're using, the value of the time that you're giving up to operate your business. And so economic profit is calculated differently, total revenue minus your economic costs, which are both explicit and implicit, not explicit only. So from now on, when we talk about costs in this course, all costs we discuss will be economic costs, not accounting costs. So whenever I use the word cost, assume that I am talking about economic costs, meaning both explicit and implicit costs. Now, we could look at an example of this. Now, suppose that Betsy earns $250,000 in total revenue from her retail clothing store. She also incurs the following explicit costs: $1,200 in debt repayment every month, so multiplied by 12 months, that's $14,400 a year. She pays wages to her employees of $35,000 a year, insurance and utilities of $40,000 a year, and she has money spent on business inventory of $150,000 a year. If we calculate her accounting profit, her revenue is $250,000 minus the $14,400 she pays in debt, minus the $35,000 she pays in wages, minus the $40,000 for insurance and utilities, and minus the $150,000 for inventory. So she would have an accounting profit of $10,600. So we would say she's profitable. But if we calculate her economic profit, this requires that we include implicit costs. So because she's using the building herself instead of renting it out, if she rented it out, she could earn $1,000 per month. That's $12,000 that she's giving up. And she could have worked at Macy's for $45,000 a year. That's another $45,000 she's giving up. So that's an additional $57,000 in money given up. When we subtract that from the profit that she had before of $10,600, we would see her economic profit is actually negative $46,400. So Betsy's accountant reports that she is earning a positive profit, but an economist knows that she's incurring an economic loss and that she should not have quit her job at Macy's to open this business. It would actually be better for her to work at Macy's than it would be to operate this business on her own. But if you're an accountant, you would say, oh, she's earning a $10,600 profit. She's profitable. She should remain in business. And the economist would say, no, 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 no. She could earn more money overall by working at Macy's than operating her business, and therefore she should close the business and work at Macy's. So here's a key tip to understand. Accounting profit, often discussed by the media and the business community, and what we normally think of as profit, is calculated without subtracting a full measure of the costs of production, which include all those other things that you give up. And that's what economists do. Now, the capital of a business is the value of its assets. So any equipment that the business owns, any buildings it owns, any tools, inventory that it's produced, any financial assets that it has, all go into producing goods and services. Now, all of those things that the business owns, if they were not using those things in the business itself, they could use them to produce something different. Or they could rent them out to someone else. Or they could sell them and put the money in the bank and earn interest on that money. So there are different things that a business could do with its capital to potentially bring in more money. The implicit cost of capital is the opportunity cost of the capital used by a business. It's the income that the owner could have received from that capital if it had been used, not for the business, but in its next best alternative way. And that's an implicit cost, that's an opportunity cost, and that has to be included when calculating economic profit. It's not counted in accounting profit. So if we look at Babette and her Cajun Cafe, we see that Babette takes in revenue of $100,000. She has an explicit cost of $60,000 and depreciation of $5,000. So that gives her accounting profit of $35,000 a year. And again, we'd look at that and say, oh, she's profitable. But if she used her capital in a different way, she could have earned $3,000 on it, so we have to include that as an implicit cost. She could have worked as a chef in someone else's restaurant, earning $34,000, so we have to include that. And when we add those $37,000 and subtract them from $35,000, we see that she has a negative economic profit of $2,000. And anytime we have a negative economic profit, it means we could be using our resources in a different way to earn more money. And so it's not the best way to use our resources. But notice, if we change one of those implicit costs, let's assume that in working in a chef in someone else's restaurant, instead of earning $34,000, she would have earned $30,000. Well, now her implicit cost is $36,000, and that gives her a positive economic profit of $2,000. If her economic profit is positive, then that means there is no other way to use her resources to earn more money. And so that becomes the issue here. So just by changing one of the implicit costs, in one way, when it's negative, that means she should do something different, but if it's positive, then she should do this. So economic profit can be negative, and you would be correct in saying that a firm is incurring a loss when economic profit is negative. And that means you should do something else with your resources. Now, a positive economic profit, if you determine economic profit is positive, this indicates that the current use is the best use of those resources. There's nothing else you could do with those resources to earn more. That's good. If the profit is negative, if there's a negative economic profit, we call that an economic loss, and that indicates to us that there is a better alternative use for our resources, and we should be doing something else with them. But what if we have a zero economic profit? What if it's not positive or negative? What if it's zero? Economists have a special term for this. They call this a normal profit. Now, let's assume that Betsy is losing $46,400 of economic profit by quitting her job at Macy's and opening her retail women's clothing store. Suppose her total revenues were exactly $46,400 higher. well, then her economic profit would be equal to 0. And so that's the break-even point. And you might say, well, what's so great about breaking even? Why do I want to break even? I'm not earning any profit. Well, of course, Betsy would love to have a positive economic profit, but let's see what a normal profit means. If Betsy has 0 economic profit, it means she has sold enough clothing to pay all of her employees, the insurance company, her utilities, the bank, and her clothing suppliers. And it compensates her for all of the rental income she gave up, and it compensates her for the salary at Macy's that she gave up. So if you can earn enough total revenue to cover every cost, both out of pocket and the things you gave up, a normal profit is not a bad thing at all. It means there's nothing else you could be doing to earn more money. Now, this doesn't mean that you have a 0 accounting profit. Your accounting profit may be positive. You may be earning a lot of positive accounting profit. What a normal profit means is that you're breaking even and there's nothing else you could do with your resources to earn more money. So that's a good thing. A normal profit means you're using your resources in the right way. So in an efficient competitive market, firms that have identical products will make a normal profit. They will break even and they'll make no economic profit. Here's an analogy from traffic. When there is heavy traffic, why do all lanes go the same slow speed? Cars leave slower lanes and they enter faster lanes, right? And so all the lanes end up going about the same speed, because if you have 2 lanes that are slow and 1 lane that's fast, people in the slow lanes are going to switch to the fast lanes, and now they will get slower. And so eventually all the lanes are going about the same speed. Well, in a similar way, this is what happens in perfectly competitive markets if firms earn positive economic profit. Remember that a firm with 0 economic profit earns just enough to cover both its implicit and explicit costs. The firm may have 0 economic profit and a positive accounting profit. That can be true at the same time. This video here by Mr. Clifford, you can go on to the ACDC Econ website and watch the video Economic Profit and Costs. You can do that on your own time. I won't play it for you right here, but it is available for you to watch, and I would encourage you to do so. If you wish, you can pause the video right now and do some of these practice questions here. I'm not going to read them to you, but you can go through these and see through practice whether or not you understand the difference between accounting profit and economic profit and what a normal profit is. Here's another example, too, that shows us why farming is disappearing in many suburbs, particularly in New England and other areas. It tells you here that in 1880, more than half of New England's land was farmed. But by 2006, only 10% of the land in New England was farming. Well, what happened to all the farmers? Well, the remaining farms in New England are mainly located close to cities and large metropolitan areas. And, farmers often will grow produce on this land, and they get paid high prices for this because people that live in cities are willing to pay more money for food that's grown locally and is very fresh in terms of fruits and vegetables and things like that. But could they get more money if they sold their land to a developer? And in many cases, if they sold that farmland to a developer, they would get more money from selling to a developer than they would by keeping the land in farming and growing fruits and vegetables and selling those. So the opportunity cost of keeping the land in farming is negative. They have negative economic profit. So it makes more sense for them to sell their land to developers instead of keeping it as farmland. And when they do that, then developers put up new stores, shops, buildings, apartments, houses on that land, and the farmland disappears. And that's not only happening in New England, it's happening in places around the country. But it's following economic laws because they're saying, well, the opportunity cost of keeping it in farming is negative. So we need to move it into something that earns us positive economic profit. And the farmland goes away. This is an activity on economic profit and costs that will review these concepts. We'll work on this in class. And I believe these questions right here, I skipped over a couple of things here, so let me go back. Okay, here's the next one on determining profit, and we will work on that in class as well. And then this is a summary of what we looked at here. I won't read the summary to you. You can certainly pause the video, read through the summary of that, and take your time in doing so. There are some questions here that follow that are practice questions that we normally do, and we will work on those in class as well. So this concludes our look at how we determine profit.